Hey there, everyone. Dave Keller here with Market Misbehavior. We're doing a series this week on the 4 deadly sins for investors. So far, we've talked about 2 of them. So if you're watching this video first, go back to the first video, watch those ones, because we'll talk about the challenges of buying too early and buying too late. As with all of these 4 deadly sins, we're going to lay out what the sin is, how it manifests in your process. We'll highlight some of the specific behavioral biases that probably cause you to have that problem, and then focus in on 1 or 2 technical analysis tools that hopefully can help you minimize those in your process. All through the course of these 4 deadly sins this week, I hope that you can think about which 1 or 2 of these you think are most powerfully being demonstrated in your own process. That's where you want to focus your attention. Hopefully 1 or 2 of these things are not as much of an issue. Maybe 1 or 2 of them are. That's where we want to focus our time and attention. My goal with investors is to help them think about how they think about their process, to identify some areas for improvement, and then hopefully make some incremental changes to make better decisions over time. So now that we've talked about 2 deadly sins involving a buying discipline, now we're going to talk about the other side. We're going to talk about selling. And the third deadly sin we'll talk about today is selling too early. And I will tell you, all 4 of these are painful in their own ways, but this one might be the worst. This is when you sell when a stock or ETF is up 10, 20%, and then you sit sadly on the sidelines and watch as the stock continues to go higher 100%, 200% or more. Has that happened to you? Again, I won't ask you to raise your hand, but I can tell on the other side of the camera, probably some of you are shaking your head going, yep, that's happened to me. It's happened to all of us, right? And what's funny is when we sell something that's up 20% or 30% and take profits, there's actually a very well-documented reason why that happens in our process. But we're going to also talk about where there's some hope, right? Where how we can maybe avoid selling too early. Now, why do we sell too early, or what is the issue with selling too early? The problem here is that the general trend in the major equity averages is higher. And this is a reality of market history, right? If you look back at a monthly chart of the S&P, here we're showing a chart of the S&P 500 going back about 100 years. That's the beginning of the most widely followed data on the S&P is going back to 1926. Here you can actually see this trend over 100 years. Generally, it's going up and to the right? And there are some periods in here where it's a little tough. For example, the Great Depression. For example, the bear market, secular bear market of the 1970s. Post .com era through the great financial crisis. These were secular bear markets that took quite some time, in a lot of cases, many years to recover from. However, the market has always recovered from even the most painful corrections in history. The market has always retraced 100% of that correction and more. And generally speaking, when we often talk about uptrends and downtrends, we're talking about shorter-term timeframes. The very long-term timeframe is generally positive. And that's the reality, right? More often than not, stocks as a market go higher as opposed to lower. So if the general trend in stocks is higher over the long term, why is it so hard for us to just remain invested and ride this price to the upside? Well, there's a well-documented behavioral bias called the dispositional effect. And what this basically means, and I'm summarizing here, is basically that it feels better for us to recognize our wins than it does to acknowledge our losses, right? When something's up 20, 30%, it feels really good. It gives us a little dopamine rush when we hit sell, when we close out that position, and we can log that 20, 30% or whatever it is, lock in that gain, right? And by acknowledging, by confirming that gain, makes us feel like we're doing a good job. Peter Lynch famously sort of addressed the dispositional effect, which said if you're selling your winners and you're holding on to your losers, it's kind of like you're trying to grow a garden and you're pulling all the flowers and you're watering all the weeds. Obviously, that's not how you grow a successful garden. It also happens to be how you don't nurture a great portfolio, right? What we generally want to do is the opposite. What I was taught is to let your winners run, right? To, if you're right, to stay right as long as possible. And when you're wrong, get out of the way as quickly as possible. But sticking with your winners can be very difficult, and it's because of that dispositional effect. Basically, it feels better for us to acknowledge the win and then just kind of ignore the loss. And that's why our portfolio can often go the wrong direction, because if we take profits on our best charts and then hold on to the worst charts, we're basically building a portfolio of underperforming assets, which again is how we chronically underperform. So we're going to talk in the next bias about how we sell stocks that are no longer working. So put a pin in that mentally, because we're going to revisit that probably in video number 4. But today we're going to talk about how we stick with our winners as long as possible. And as I mentioned, there's nothing worse than being on the sideline, selling at a gain, but then watching as the price continues to go higher. And there are so many recent examples of that. It's hard to pick just one, but Palantir is probably a good one. This is the chart of Palantir from 2022, 2023, 2024 into early 2025. And obviously from the end of 2022, Palantir with just an exceptional 2-year period of growth. It's been obviously a choppier period here more recently in 2026, but by the beginning of 2025, Palantir really exerting itself as a top-performing name during that 2-year period. So it was very tempting if you were early on Palantir to be selling on the way up, right, and taking those profits. But what we want to talk about are ways that we actually stay in here as long as possible. So what are some of the technical analysis tools and techniques we can use to remain invested in a trade? This is where the trend following toolkit comes from. It comes from recognizing that charts that are strong often remain quite strong. If you don't believe me, just Google momentum factor and read up whatever academic or broker research comes up that tells you all about the momentum factor and why it works. That is essentially a well-documented market phenomenon that charts and stocks and ETFs that are strong often remain strong over a certain period of time. In very short-term or in very long-term time frames, not the case. But in that medium-term time frame, right, a couple months or so to a year, momentum investing really tends to work. Even after investors and academics have defined this factor and studied it deeply, it still outperforms even in 2026. So the momentum factor is real. So as a trend follower, how do we take advantage of those long-term uptrends? So what we want to do is stay with the trend as long as possible. We want to turn from a trend disbeliever into a trend follower. This is where it actually helps to be a follower, because we just want to stay with this trend as long as possible. So what are some of the characteristics of the chart of Palantir or other winning charts that should give us confidence to remain in a trade as long as possible? So I would say number one, go back to that first video we did where we talked about the different phases, right? As long as a stock remains in an accumulation phase, I probably shouldn't get scared out of it, which means as long as we keep making higher highs and higher lows, as long as the moving averages keep sloping higher, those are, kind of simple ways of defining an uptrend and recognizing when that trend is in place. In a longer-term time frame, the 200-day moving average is one that I often refer back to, right? If you look at the chart of Palantir in 2023 and 2024, we actually had a number of decent pullbacks. For example, this is one going from like $30 to $22 a share. That's not a tiny move, and that's actually a pretty significant drawdown. You can see other drawdowns that happened earlier on in that phase, but those painful pullbacks, those painful corrective periods always remained above the 200-day moving average. So as a long-term investor, one of my basic gut checks, are we still above the 200-day moving average? Then I probably shouldn't be making too many rash decisions in a long-term portfolio if that remains true. Another way we can think about strong uptrends is thinking about momentum, right? In an uptrend phase, the RSI will often spend most of its time above 50. On pullbacks, the RSI won't get much below 40. So as long as that happens on pullbacks, I probably should remain in pretty good shape with it. Another thing I've learned is focusing on stocks showing strong relative strength or relative performance. As long as the stock continues to outperform the benchmark, I probably shouldn't get too worried about taking things off the table. And I would say when you have a chart that's going higher, like Palantir was in this case in 2025, so we're going a little bit further now, again, go into trend following mode, right? If you find you're selling too early, What you want to do is just be a trend follower and just use techniques that allow you to remain engaged in the price. This example right here, sort of mid-year 2025, I think is a great illustration of some common trend following techniques. The 21-day exponential moving average is often my initial stop, particularly on a short-term time frame if I have a new position. So I would add the stock, and then if and when we break below the 21-day EMA, I probably wouldn't sell the entire position, but maybe I take a little bit off. It's just a recognition that maybe the trend's starting to change a bit. And if the uptrend resumes, maybe I add it back. But if the deterioration continues, maybe I continue to lighten up my position. The 50-day moving average also becomes pretty valuable. And as long as we hold the 50-day moving average, then conditions just aren't getting that bad. I mentioned momentum. So here's the chart of Palantir 2025. Look how the RSI, even though there are a number of pullbacks, in some cases which broke below key moving averages, the RSI never got much below 40. And that's a good reminder that we're still in an accumulation phase. In an accumulation phase, the price should become overbought on pushes to new highs, ideally, and the RSI shouldn't push much below 40 on pullback. So as long as that continues, I'm probably in pretty good shape. Now, these are some of the technical indicators that I use to sort of follow trends higher. There are others as well, and one that I would point you to is called the chandelier exit system. If you look at books by Dr. Alexander Elder, and I'll try to remember to include a link on this one if you want to check it out, but he talks about the chandelier exit technique. That is a trailing stop technique based on average true range, or ATR. When I talk to people about their exit strategy, and particularly with trend following, I encourage people to get to average true range in your process, right? There are different ways that we can, use stops, use trailing stops. A certain percentage or dollar amount off of a high is a very simple but, not very dynamic system. Moving averages are good because they adjust to the price data, but again, are a little bit lagging. Average true range is pretty helpful because what that does is it ends up giving you a dynamic stop based on the volatility of a position or of a normal price action. Here's what I mean. Palantir is generally going higher during this period, but the daily wiggles and squiggles, right, sort of the intraday movements and the movements over a couple days, couple weeks, has a certain rhythm, and different stocks have different volatilities, right? The range of the stock, the daily trading range, is the open minus the low. The true range is that daily trading range, but adjusted for gaps, because a lot of times equities will have those gaps. So an average true range includes gaps in that calculation of the daily range. And an average true range of ATR means we're looking at the daily trading range adjusted for gaps and taking an average over a period of time. So the ATR is a great measure of sort of the average kind of noise that a stock experiences, whether it's in an uptrend or a downtrend. This is kind of the normal amount of volatility. So with an average true range based exit strategy, we are getting a signal when the price is moving not just with the normal rhythm, the normal noise, but something more significant. So the chandelier exit system is a really good one to think about. And again, we'll include a link to a book on that and also some free resources that explain a little bit more about the chandelier exit system, because that's one that I encourage people to get to. So there you go. The third deadly sin of 4 is selling too early. I'm sure this has happened to you because I know it's happened to me, and it happens to all investors at some point. There's nothing worse than selling early and sitting on the sidelines and watching the price continue to go higher. So if that's happening to you, what you want to do is make sure that you build out your trend following toolkit. Use moving averages, pay attention to the phase that we're in and make sure we're still in an accumulation phase. And then think about some trailing stops that not only tell you when to get out, but also encourage you to remain in a trade as long as the stop is not hit. And that's the benefit of a trailing stop approach like the chandelier exit system. You stick with the trade as long as the trade's still working for you. We'll be back tomorrow with the fourth deadly sin for investors. I hope so far these videos have made you think a little bit. I hope today's video makes you think a little bit about your trend following approach. And I'm sure by watching my market recap show, once we're back from vacation, it's going to give you plenty of examples of how we can stick with winning trends as long as they persist. For Market Misbehavior, I'm Dave Keller, reminding you it's always a good time to own good charts. Take care, folks.